Peter Rose, Longwood Currency Trading. Having my morning coffee. It's raining out. This is end of September of 2022. We have a kind of a chilly, rainy day. Thoughts on entry analysis being difficult. Look, when you look at the what I call the life cycle of a currency pair, this is taken from my 33-year career as a senior software engineer, where I lay out in my training for folks that want to chat with me about trading, the logical sequencing of the solution of a problem. And there are phases that you go through in the solution of problems. The life cycle of a currency pair is the stages that a currency pair goes through when you are thinking about putting it on, which is called entry analysis. What happens while you have a trade running, which is your position management. And then finally, how do you get out of the thing? Your exit methodology. When do you get out? Do you know, all those sorts of questions. So entry analysis, position management, and exit methodology. The issue here is that if you have crappy entry analysis, you're never going to get to the position management stage. You're not going to have to concern yourself with closing at a profit. The entry analysis is really the trick of the thing. When I first started trading, I thought the entry part was easy. It was either going to go up or it was going to go down. You had a 50-50 shot, and by adding a little bit of analysis, you had a certain percentage that it was working in your favor. In a flipping coin, it's a 50-50 thing. You're not going to change that. However, if you could weight the side of the coin in some way to change its aerodynamic capabilities, you might end up 2% more likely that it'll go to heads, for example. That's a huge, huge difference. And so in your entry analysis, it's true. If you can get the right, over a period of time, you develop certain metrics. Your win-to-loss ratio, your average win value, and what's called a per-trade expectation value. But you take those three metrics, and they give you, hopefully, if you've been doing your work, an edge. And that edge might be 2%. Now, when I do a video on analysis, that percentage edge is comes out to be like 17% or something like that. That's the theoretical point. What that doesn't take into consideration is the variability of the psychology of not only the retail market, of which we're just 15% of, but also the order flow books that the large institutional traders have at any given time, and at what stage they're in executing that. And for that, you can't just look at a picture and go, oh, boom. You have to look at a system. And so entry analysis, although I teach it as a very simplistic thing, as you peel the onion back and you go further into the training, which is the result of my looking at these markets since 2007 and actively trading them since 2012. You get a sense for things. But the object of transferring that knowledge of what's going on and how you might want to look at these markets is a very detailed process, and it needs that phasing in of a system: entry analysis, position management, and exit methodology. Within the entry analysis phase itself, there are probably 3 or 4 sub-phases, steps that you go through. One of them, for example, is, well, what's the long-term 4-hour, the weekly chart? What's that showing you? Looking at your boundary conditions and things like that. The problem with doing all of that, as you're well aware if you've done any kind of trading at all, or listen to anybody who's talking about trading, is that you have these anomalies, which aren't anomalies because they happen all the time. For example, in the United States, we have Consumer Price Index, a CPI notification that comes out. And everybody can speculate all they want on what that's going to be. And you see people taking positions on that. And so, for example, if we look at September's CPI back on the 13th of the month, there was a tremendous run-up in USD-based denominator pairs, the pound dollar, the euro dollar, and things like that. The dollar just evaporated. You'd think the dollar wasn't even there. The pound went up, the euro went up, everything went up, hundreds of pips. So if you'd have been on the other side of that trade, which I was for part of the way, you would have been up. You would have been down about 158, 170 pips or something like that the price would have run. What you would think, well, we've got a CPI coming up here pretty soon. Why would the dollar deteriorate or the pound or euro get so much stronger over that period of time when the Fed is fighting inflation rates, and you have all these fundamental things that are going on, and you're saying, well, the dollar should be strengthening. And they said all along, well, the dollar has strengthened. It's gone from sub 100 to now 109 or 110 on the DXY. And so it would seem to be counterintuitive to say that the dollar is going to weaken when over the past the dollar had strengthened. Why would it be weakening now when it appears that the U.S. is getting back on its feet, but the other countries are having worse problems than we are, and so it should be the reverse. And that's the danger in looking at the news or looking at fundamentals, is that you develop an opinion. And as I've said before in many of my videos, save your opinions for movie reviews. They're just not going to hold water on the thing, because the price is going to do what the price is going to do. We can look in hindsight now, looking back at that September 13th release of the CPI, when the pound dollar, for example, fell 170 points in about 15 minutes after running up about 200 pips, 220 pips or something like that, I think. Why was that? Why was everybody so wrong on the CPI? Well, let's look at order flow. The run-up in the pound dollar, for example, if you go back to early September, you're going to see that rise in prices going on, and it's significant and consistent. And it looks like you've hit a major swing the way that price is moving. It just didn't spike. I mean, it's just climbing, gradually, a little bit down, a little bit down. You're sitting there going, wow, when's this going to end? Well, the chart pattern didn't appear to have an ending. It appeared that there was an accumulation of pounds and euros, if you're looking at the other charts. The people were very interested in buying them. In other words, they thought maybe that they were cheap before, and now the economies are getting better, and so they're buying the pounds because they feel that it's going to go up. Let's look at it from the institutional order flow, because they're the dogs in this, and we're just a tail. They've got these large institutional orders. If the pound was getting hammered and it was down low, then they're not going to be able to buy anything. What's the danger here? We've got a Ukraine war going on. Energy prices are spiking all over the world. My electric bill here at the house, as a small house, and I'm not powering a laser or anything like that, went up 35% last month, and it's going to stay that way because of the demands on the gas market, which turns into diesel and gasoline and power and all that other sort of stuff. So we need to be having that pound strong so that we can buy the euro strong, the pound strong, all those, so that they can use that money to buy energy products all over the world, to buy precious metals all over the world. They need that. You know, during all this, the pound is going up and the dollar is going down, and you get this 200 pip pound dollar rise, and yet the price of gold is going down from 1870 an ounce to I think we're down 1750 or 1730, $100 an ounce. That's a lot. Why? The institutional traders don't just work for the bank as traders. They're executing customer orders. So they're saying, we want to buy a lot of American oil or American something or other, or Russian products while they still can. Whatever. You got to buy whatever you got to get whenever you get it. And so the customer orders are saying, we need our currencies up so that we have buying power, because we're going into the winter. So the consumer price index then comes out in the U.S. That's a perfect excuse to say, wow, the dollar should be going up here, and because the Fed they're not going to lay off the interest rate rises. And what happens to price? They say, we're all done with our need for our strength, and now it's time to sell that. And what are they going to buy? They're going to buy U.S. dollars, because that's where the real strength is going to be through this cold winter. And so there you have maybe a possible scenario beyond what you would see in the charts, what you would see in the fundamentals, what you would see just in your opinion as to what you think that price is doing. And because so many of the folks out there saw the dollar weakening and the pound and the euro going up, they changed their opinion. They go, oh, well, I'm going to get involved in this. Great, everybody gets involved, and there's price going up very slowly, which means people are buying it consistently. There is tremendous trust that they're making a good investment on their money, and they're seeing that money grow. And then all of a sudden the institutions say, we're done. We're ready to sell our euro positions. We're ready to sell our pound positions. And they start selling. Now all these people from the retail side that were long, they're getting caught, and they're executing their shorts. Just as the institutions were triggering the buys for these guys that were short the pound dollar, for example. And so they're just picking it up on both ends. You know, the institutions are like a broker. They're going to make money whether they're selling or whether they're buying. It doesn't matter. And so when you're looking at your entry analysis, although it's interesting to look at the economics of the two pair countries, it's interesting to look at the fundamentals, it's thrilling to look at where moving averages are, and if you're crazy and you're doing fibs and crap like that, you're seeing all this stuff self-prophesizing itself until something like the 13th happens and price drops in 15 minutes. What it took 5 or 6 or 7 days for price to go up, as the institutions who really know what's going on load it up. So how do you do that when you are starting out in your currency journey and you're not trading a large enough size in order to go in light and then go in heavy after the price direction proves itself? What are you supposed to do if not trust the fibs and what all these people are saying about excuse me, RSI and all the rest of these crazy indicators that have absolutely nothing to do with price action? They are confirmations of what price did, but not in time for you to use it, because it's gonna bounce off the 58 level. It doesn't. Well, 58 wasn't strong enough, so it's gonna go to the 60. No, it just, after the fact you can look at it and go, oh, it respected the 64 because why? Because you decide that you're gonna sell a fib system or an RSI system or a friggin' Elliott wave or whatever it is that you're looking at that's stupid. It's based on order flow, and order flow is based on economic need of exchange between the two pair countries. Don't forget that. But the exchange between the two pair countries is also dependent on the exchanges of other pair countries, not just the one that we're in, because it's a global market. The Forex market is a global market. You're not just buying Ford stock. You're not buying gold. You're buying economies or selling economies of these two countries that are paired up with dynamic international exchange between them. And so when you're doing your entry analysis, as you have a larger account, you need to become a little bit more aware of the ramifications of these price patterns that are being drawn on the chart to being something more than, oh, this is a flag pattern, or this is a range-bound market with a breakout. What do those mean? You can't just say, oh, the price broke out, and then do that. You have to have a reason for why that could be happening. And 9 times out of 10, the reason for that is counterintuitive to what your opinion would be. I get caught all the time on this stuff. I'm interested in the economics. I'm interested in all of this stuff. And so unfortunately, I form an opinion. And I'll go in and I'll go, oh, I think this is going to happen. You know what I should do when I say, oh, I think this should happen? I should go take a shower or something, or go walk in the woods with my dog Bo. Don't put a limit order on there to have that pooped out, because I'm going to be wrong. Because it's very difficult to live your life in an intuitive manner and then sit down at the currency trading desk and become non-intuitive. Take the opposite of that. If you haven't been trading long enough, you will disagree with that. If you've been trading long enough and you don't understand what's happening, it's your intuition that is screwed up. And it's causing you to form opinions and conjure up some version of the news or version of the fundamentals that fits your opinion. You're not making your opinion fit the news and the fundamentals. It's the other way around, and that's why it's not intuitive. So in looking at that entry analysis phase, I spend a tremendous amount of time talking about that phase and referring back to it. And most of the videos that I've done in the last couple of months now, although they've been on how to trade a large size bank, they constantly are referring back to that entry analysis that you have to do, because if you don't, when you're in position management, you're not forgetting about the entry analysis, because you have to remember why you're in the trade. Because in your position management, when the story that gave you the successful entry begins to change via the price action that you're seeing, you've got to go back to the entry analysis and say, if price was doing this now, would I enter? And if the answer comes back no, boom, you're out, no matter what you think that price is going to do or how far you think it's going to continue on. And that's why in the last 6 or 8 videos that I've done, there's been quite a few that talk about staging. When you get the larger account sizes, 5 full lots up from there, you have to stage in. You don't want to go in, if I'm trading with a 6-figure account, I don't want to go in with 20 full lots, $200,000 bet on the entry. I'm going to go in with maybe a $30,000 bet, trade 3 full lots. If it doesn't go in my favor, I get out, I got a short loss. 20 pips They lose $600. Okay, that's great. Or $400 on 20 pips on a $20 a pip value. But you're not being cautious with your money. What you're doing is you're going, if I get this right and it goes in my direction, I'm going to add to that. And if it goes beyond here, I'm going to do this. And if it goes to here, I'm going to do that. But does the story change? Does the entry story, do the parameters of why I made that entry decision, have those parameters changed? Now, any dumbass can look at the chart on September 13th of the pound dollar and say, oh, we've had this continuous rise up contrary to the fundamentals, and we have the CPI coming out, and if that goes bad, this thing is going to go down like a brick. Okay, well, if everybody knew it was going to go down like a brick, if you could figure that out ahead of time, then why did so many people get caught in that move after this really gradual rise up over 240 some odd pips over quite a period of days? Maybe it wasn't 240. I don't know what it was. It doesn't matter. Why would it all of a sudden fall off the cliff? Why would everybody be running for the exits? So don't listen to these guys that are out there trying to teach you this stuff from a very mechanical standpoint. Oh, I bet all the robots did real good with that trade. Yeah. Those automated systems work great until they don't, and then they take your whole account. Can you imagine having your whole account wrapped up and then all of a sudden you drop 160 pips? Even with a conservative 20 pip or 30 pip stop, I don't know how they're going to do that. You got to be really careful with that stuff. You need to be there with your finger on the bid ask, ready to either enter when the conditions validate where your experience feels that price is going to go from a probabilistic stance, not from an intuitive stance, but from a probabilistic stance. And then once you're in the position, constantly referring back to that line of thinking in your entry analysis to say, is this continuing or is something changing that price action? And maybe I should be aware of that. And then, of course, the question is, and what I deal with students, is how do you determine when that sentiment begins to change? How sensitive should that be? There's certain parameters. There's 3 or 4 rules around that as to how you change from being long, for example, to saying, man, I don't think this long is going to continue on. It isn't necessary that you think, oh, it's going to flip around and maybe I want to be short. It's just that the long is starting to weaken and maybe I better get out. But that's constantly referring back, right, to that entry analysis stage. So entry analysis is a lot more involved than just spending 5 minutes looking at the chart and going, okay, I think this is where I want to get in. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.